Most people spend 40 years working for money, then wonder why they're still struggling financially. What if you've been taught to think about money completely backward your entire life? Rich Dad, Poor Dad isn't just another personal finance book. Since its publication, it's changed how millions of people understand wealth. And here's why it matters now more than ever. We're living in a time when salaries aren't keeping pace with inflation, job security is uncertain, and traditional retirement plans are failing. The uncomfortable truth is that financial education isn't taught in schools. Most of us learned about money from people who were following the same broken playbook. Go to school, get a good job, save money, buy a house, retire at 65. But that strategy isn't producing the results it promised. This book introduces a fundamentally different way of thinking about money, not complicated, not risky, just different. Let's break down the ideas that separate the wealthy from everyone else, the difference between assets and liabilities. Here's the foundation. Everything else builds on. Rich people acquire assets, while the poor and middle class accumulate liabilities that they think are assets. Sounds simple, but this confusion is keeping most people trapped financially. An asset is something that puts money in your pocket. A liability is something that takes money out of your pocket. That's it. Forget the accounting textbooks. If it generates income, it's an asset. If it costs you money, it's a liability. Now, here's where most people go wrong. They buy a house, a car, the latest gadgets, and they think they're building wealth. But look at your bank account. That house has a mortgage payment, property taxes, insurance, maintenance. Your car has loan payments, insurance, gas, repairs. These things are pulling money out of your pocket every single month. The middle class works hard, gets a raise, and immediately increases their lifestyle. Bigger house, nicer car, better vacation. Their income goes up, but so do their expenses. They're running faster on the same treadmill. Wealthy people think differently. When they have money, their first question is, what can I buy that will generate more income? Rental properties that produce monthly cash flow, stocks that pay dividends, businesses that generate profit, intellectual property that creates royalties. These are assets. Let me give you a practical example. Two people each have $20,000. Person A uses it as a down payment on a new car. Now they have a $400 monthly payment for 5 years, plus insurance, plus gas, plus maintenance. That $20,000 is now costing them money every month. Person B uses that same $20,000 as a down payment on a small rental property. They rent it out for more than the mortgage payment. Now that $20,000 is generating income every month. Plus the tenant is paying down the mortgage, building equity, plus the property likely appreciates over time. Same starting point, completely different outcome. The lesson isn't that you should never buy things you enjoy. The lesson is build your assets first. That your assets buy your liabilities. Once your rental properties are generating $500 a month, let that income pay for your car. Then your car isn't draining your wealth. Your assets are covering it. The rich don't work for money. This sounds counterintuitive. Everyone works for money, right? Here's what this really means. The poor and middle class work for a paycheck. The rich work to acquire assets that generate income without their direct labor. Think about your current job. You trade your time for money. You get paid only when you're working. If you stop working, the income stops. That's working for money. You are the engine. If the engine stops, everything stops. Now think about owning an apartment building. The rent comes in whether you're working that day or not. Whether you're on vacation or sleeping or spending time with your family, the asset is producing income. That's money working for you. Most people are stuck in what's called the rat race. They wake up, go to work, pay bills, wake up, go to work, pay bills, wake up, go to work, pay bills. Even high-income professionals, doctors, lawyers, engineers making 6 figures are often in the rat race. They make more money, but they also spend more money. They can't stop working because their lifestyle depends on that next paycheck. The goal isn't to work for money your whole life. The goal is to work hard for a period of time to build assets. Then let those assets generate income so you have choices. Here's a relatable scenario. Imagine you're making $70,000 a year at your job. You're comfortable, but you can't really stop working. Now imagine you spend 5 years building a portfolio of assets, rental properties, dividend stocks, a side business, whatever fits your situation. Eventually, those assets are generating $30,000 a year in passive income. Suddenly, you have options. You could work part-time. You could take a lower-stress job. You could pursue something meaningful that doesn't pay well but fulfills you. You could spend more time with your children while they're young. The assets give you freedom. That's the difference. Working for money keeps you dependent. Building assets creates independence. Mind your own business. Most people confuse their profession with their business. Your profession is what you do for a paycheck. You're a teacher, an accountant, a manager. That's fine, but your business is your asset column. Your business is what's building wealth for you. The problem is that most people spend their entire careers minding someone else's business. They work hard to make their employer rich, to make the bank rich through mortgage interest, to make shareholders of the companies they buy from rich. Everyone gets rich except them. The advice here is straightforward. Keep your day job if you need to, but start building your own asset column. Start small. Maybe you begin investing in index funds. Maybe you buy a duplex and rent out half. Maybe you start a small online business that runs on weekends. Maybe you create a digital product that generates passive income. The key is that you're actively working to build something that will generate income independently of your time. Here's a real-world example. Someone works as a software engineer making good money. That's their profession. But on the side, they're buying dividend-paying stocks every month. They're building a portfolio. Their profession pays the bills. Their business, that growing portfolio of assets, is building their future wealth. In 20 years, the engineer who only focused on climbing the corporate ladder might have a good salary, but still depends completely on that job. The engineer who minded their own business might have a portfolio generating $50,000 a year in dividends, giving them true financial security. You don't have to quit your job to mind your own business. You just have to start treating your personal wealth building with the same seriousness you treat your job. Financial literacy is your superpower. You can work hard your entire life and still struggle financially if you don't understand how money works. Financial literacy means understanding income statements and balance sheets, not just for businesses but for your personal life. It means understanding the difference between capital gains and cash flow. It means understanding taxes, debt, inflation, and how to make them work for you instead of against you. Here's why this matters. The tax system is designed to benefit business owners and investors. Employees pay the highest tax rates. They earn money, it gets taxed, and then they live on what's left. Business owners and investors earn money, spend it on their business and investments, and then pay taxes on what's left. That's a fundamental difference. Someone who understands this can legally reduce their tax burden by thousands of dollars a year. Someone who doesn't just pays what they're told to pay. Financial literacy also means understanding good debt versus bad debt. Bad debt is borrowing money to buy liabilities, putting a vacation on a credit card, financing a car you can't afford. Good debt is using borrowed money to acquire assets that produce more income than the debt costs. A financially literate person might use a mortgage to buy a rental property where the rent covers the mortgage and produces extra cash flow. They're using the bank's money to build wealth. And financially illiterate person uses a mortgage to buy the biggest house they can qualify for, creating a massive monthly expense. The school system doesn't teach this. You have to seek it out yourself. Read books, take courses, study how money actually works. Every hour you invest in financial education can be worth thousands or even tens of thousands of dollars over your lifetime. Pay yourself first. Most people pay everyone else first. The government through taxes, the bank through the mortgage, the credit card company, the utility company, and then save whatever's left over, which is usually nothing. This approach reverses that. When you get paid, the first thing you do is pay yourself. Put money toward your investments and assets before you pay your bills. This sounds irresponsible, but here's the psychology. When you pay everyone else first, there's no pressure to earn more or manage your money better. When you pay yourself first and money is tight, you get creative. You find ways to earn more. You cut unnecessary expenses. You're forced to grow financially. It also ensures that your financial future is actually being built, not just talked about. Practically, this might mean automatically investing 10% of every paycheck into your asset column before you do anything else. Before rent, before groceries, before anything. That money is working for your future immediately. Over time, that 10% compounds. It grows. It starts generating its own income. And because you never had it in your spending account, you don't miss it. You adjust your lifestyle to the 90%. This one habit, consistently applied over years, can be the difference between retiring comfortably and struggling financially in old age. So what can you actually do today? First, audit your current finances. List everything you own and ask honestly, is this putting money in my pocket or taking money out? Your car, your house, your possessions. Look at your actual cash flow. This clarity is the starting point. Second, start small with assets. You don't need thousands of dollars. You can begin investing in fractional shares of dividend-paying stocks. You could buy a course that teaches you a valuable skill you could monetize. You can start a small side business with minimal capital. The key is to start. Third, commit to financial education. Read one book on investing, taxes, or business this month. Listen to a podcast. Take a free online course. Treat your financial education as seriously as your career education. Fourth, implemented, pay yourself first, starting with your next paycheck, even if it's just 5%. Automate it so it happens before you can spend it. Build this habit now. Fifth, shift your mindset from "I can't afford it" to "How can I afford it?" The first statement shuts down your brain. The second forces you to think creatively and find solutions. The path most people follow, work hard, save money, hope for the best, isn't producing financial freedom. It's producing financial stress. The principles in Rich Dad, Poor Dad aren't complicated, but they are different from what you've been taught. Assets versus liabilities. Making money work for you. Minding your own business. Building financial literacy. Paying yourself first. These aren't get-rich-quick schemes. They're a different operating system for thinking about wealth. And the beautiful thing is that you can start applying them right now, regardless of your current situation. The question isn't whether you can afford to learn this. The question is whether you can afford not to. Your financial future isn't determined by how much you earn. It's determined by how much you keep, how hard that money works for you, and how many generations you can keep it working for. If you found this valuable, subscribe for more breakdowns of books that can genuinely improve your life. The next one might be exactly what you need to hear.